Thanks, Carmen. Good afternoon and welcome, everyone. Thank you so much for joining us today for this lunchtime webinar program. I am Dottie Weston Murphy. I am the Senior Vice President for Development and Donor Services at the Community Foundation for Greater New Haven. And I wanted to welcome my co-hosts. This program today is brought to you by the Community Foundation, by the Valley Community Foundation, Executive Director Sharon Closius, and the Jewish Foundation of Greater New Haven, Executive Director Lisa Stanger. We're so pleased to be bringing this program to you virtually today. And it's an hour-long program. And I'd like to go over some housekeeping items before we start the program today. The presentation will be approximately 50 minutes, and then we're going to leave the last 10 minutes for Q&A session. So there'll be a lot packed into our 1-hour program. If you have any problems with technology, please use the chat area, and we have staff manning that area to answer your questions. If you have a question during the presentation, please put it in the Q&A box, and we will get to as many questions in the 10 minutes that we'll have remaining. And if we don't get to all the questions, we'll try to capture them after the program and get back to you. All right, so I'm delighted to introduce our featured speaker today. I've had the pleasure of hearing Dr. James at some of our national conferences over the years and have learned so much about words and messaging that matters in our plan giving arena. Dr. James is a professor of personal financial planning at Texas Tech University and speaks nationally on the topic of charitable planning and research that has helped inform his work over the years. And so we're so glad virtually to be able to bring you this program. And this program today is really going to focus on opportunities in June 2020 and what we can do, how we can do our work differently. And the program today is we're really glad to have attendees that are from the professional advisor area, as well as our development colleagues of our local nonprofits. So I will turn the program over to Dr. James. Welcome.
Okay, thanks so much. Well, I'm looking forward to the presentation today. You know, it's really a situation where we've got so many unusual opportunities right now because so many different things have happened. So this is a bit of a different presentation because we're looking at things that we can do right now in June or July of 2020. And we're going to focus on things that, you know, you couldn't have done a year ago. Okay, and the way that this presentation is going to work, we're going to start out with some simple concepts, and we'll get increasingly complex and obscure as we look at all the different ways we can take advantage of the circumstances that we have right now today. Now, you may already be familiar with the fact that there are some special one-time opportunities that we have right now that we haven't had before. The June and July Section 7520 interest rates are the lowest ever in recorded history. And so that creates some planning opportunities, some obvious, some a bit more obscure. Also, we've got this new rule from the CARES Act that donors can now eliminate 100% of their income with charitable deductions from gifts of cash just this year. So we'll talk about some unusual ways to use that particular opportunity as well. So again, we're going to be moving today from the simple to the complex. And what we're going to look at is we're going to look at the strategies themselves, but we're also going to look at how things are different right now and how those strategies are different in our unusual environment. Of course, one part of the unusual environment has been the massive market volatility. But do keep in mind that there are still a lot of appreciated assets out there. Yes, we did have that massive drop. We've had a substantial recovery from that. But look, if you go even during that drop, if you went back 3 or 4 years, those assets were still worth more than what people paid for them. And certainly after that recovery, we've still got a lot of appreciated assets out there. And appreciated assets are important for charitable planning because that's the most tax efficient way to give, is to give with appreciated assets. And of course, not everything went down. If you have people who are invested in gold or other non-market assets, for example, farmland, or if they were just really smart and decided to invest in Walmart or Amazon or some pharmaceuticals, or a big winner was Clorox, who knew that was going to be popular last year. So there are lots of other things that never went down at all. Now, I mentioned that appreciated asset gifts are the way we want to give. And the reason we want to give that way is because they are objectively cheaper. Just straightforward. If I make a gift of cash, I get a tax deduction, which maybe I can use. If I'm itemizing, maybe I can't. But if I make that gift from appreciated assets, I get a tax deduction of that same amount. But on top of that, I avoid capital gains tax, which is a benefit I can get regardless of whether or not I'm itemizing. And so just as a quick comparison, the reality is asset gifts are cheaper. And if we start with itemizers, they're cheaper because if we make that same gift as a gift of appreciated assets, we get a double tax benefit, not only a deduction of the amount of the gift, but on top of that, we also get the avoidance of capital gains taxes. Of course, asset gifts are way, way cheaper for non-itemizers. Why? Because they can't use the deduction. So the only tax benefit that non-itemizers can use is the avoidance of capital gains tax. So it's even more important for that group. And by the way, it's also particularly important for anyone who is in a state that charges state income taxes. Now, this became a big deal because it used to be state income taxes weren't as painful because you could deduct them on the federal tax return, but now most people are capped out of that deduction because of the state and local tax deductions. And so those state taxes, whether they're state income taxes or state capital gains taxes, they are much more painful than they were before the 2018 tax return. Consequently, avoiding those state income taxes or state capital gains taxes through charitable giving, that's much more powerful today than it was before. So I want to start out with the most important strategy. Just always keep this in mind for giving, and that is what I like to call the charitable swap. Now, this is a very straightforward idea. It's the idea that if you have a donor who is, let's say, getting ready to write a check for $100,000 to an organization, instead, as financial advisors, we want them to give appreciated property, but they might come back and say, well, I've been holding those shares of Apple stock for years. I really want to stay invested in Apple stock. Well, the reality is you don't need to change your portfolio at all. You simply do a charitable swap where you donate the shares of appreciated stock. You take the cash that you were going to have donated and you use it to immediately purchase identical shares of stock. It doesn't change your portfolio at all. You still own the same shares of stock in the same companies. The only difference is now you've wiped out all that capital gain from your portfolio. Now, for those of you who are familiar with the wash sale rule, this prevents you from doing this kind of a transaction with lost property. But here, we're not dealing with lost property. So we don't have any waiting period rules. We're dealing with gain property. By the way, you never donate lost property. You sell it, take the loss. That's a tax advantage. But with appreciated property, we donate that and we can immediately repurchase identical shares the same day, the same moment, the same instant. There's no waiting period. There's no wash sale rule. And so the great result of this is you don't need to change your portfolio. You don't need to change your investment strategy. This is just a free benefit where you wipe the capital gains out of the portfolio. Now, if you're dealing with organizations, maybe you've got a donor who deals with organizations that say, we don't know how to accept gifts of securities. There's a medallioning process and all this sort of hassle that maybe they're not complex enough to know how to deal with. That's not a problem. We do the same thing. We simply run it through a donor-advised fund. So the gift is made to the donor-advised fund, which knows how to deal with accepting gifts of securities, for example, very easily, very naturally. And what the charity gets is they simply get cash out, a check that comes out from the donor advised fund. So depending upon which charitable organizations the donor wants to support, this is often an easier way to do this kind of a charitable swap. By the way, looking at some research, who are people who are more likely to make these kinds of donations? This is from a nationally representative study. What we find are the three most important characteristics, aside from actually having the appreciated assets to donate, is number one, high income, number two, high education, and number three, being at age 65 or older, that is being at retirement age. We didn't find any differences for other sort of demographic characteristics. These are the predictors of who is most likely to do this. And by the way, when it comes to giving, tax incentives do matter. Not only do they matter in general, they matter in particular for different kinds of causes and different kinds of giving. So for example, in one piece of research, again, nationally representative data, we found that giving cash to education was about twice as responsive to tax price as giving to religion. But giving stocks, bonds, and mutual funds to an organization was almost 10 times more responsive to tax price than giving cash to education. So that means when you're talking about gifts of assets, those gifts are very responsive to tax circumstances. It's very important to talk about tax benefits when we're talking about gifts of assets. So do keep that in mind. So by the way, how do we talk about gifts of assets? Well, we've learned a few things from experimental research about how to talk about these things. And let me first deal with this topic. And this is the topic of, should you mention tax benefits? Now, I know for the financial advisors that are on the conference here today, you're probably saying, well, yes, of course. I mean, that's where the conversation starts. But I know we've got some fundraisers on here, and you may have gotten bad advice about this. That bad advice in part comes from one issue we come up with in research, which is called social desirability bias. What that means is simply this. If you ask people about their motivations, they're going to report the socially approved motivations. They're not going to report motivations that are not as socially admirable. Now, the issue comes up in bad fundraising advice when you get an organization that will say, we want to know why people give money, so we're going to send out a survey and ask them, why did they donate? And they'll give people different options. You know, I donate because I want to change the world, because that's my values, because I care about these things. And then one of the choices will be, I donate because I want tax benefits, right? And then they'll get the results back and say, oh, nobody donates because they want tax benefits. They didn't check that box. And then they'll say, you shouldn't talk about tax benefits. Well, that's complete nonsense. Number one, we can't test things like that in that way. In other words, we've got to deal with social desirability bias. The second issue is that tax benefits are never the motivation to make the gift. They only relate to the cost of how expensive or painful it is to make the gift. So let's look at some other experiments where we just randomly assign people. So for example, in this, which was recently published in an academic journal, we sort of randomly assign people to whether or not they had a description of make a gift of stocks or bonds to charity, or avoid capital gains tax by making a gift of stocks or bonds to charity, and ask them about if they're interested in doing this now. Well, it turns out people are more interested in avoid capital gains tax by making a gift of stocks or bonds to charity than simply make a gift of stocks or bonds to charity. In another set of experiments, we decided to test this with some more complex charitable instruments. We start out here with 3 different descriptions of a charitable gift annuity. By the way, in the experiment, the text was all the same in all 3 cases. I've just highlighted the differences between these 2. Again, people are randomly assigned to one of 3 descriptions of a charitable gift annuity, one that makes no reference to a tax deduction, one that puts the reference to the end, and one that starts with the reference of the tax deduction. As you can see here, adding that reference to the tax deduction and even bringing it to the front both increase interest in making that kind of a gift. Now, I mentioned we randomly assign people to these 3 different descriptions, but just in case we wanted to make sure we didn't just happen to get lucky, we went ahead and spun the wheel and rotated the descriptions so that now we're using a description of a retained life estate, also called a remainder interest deed. And now the people who received the description that started with the tax deduction, they now receive the description that has no reference to the tax deduction. And as you can see, even though we rotated the groups, we still got the same result. No reference to the tax deduction, the lowest level of interest. Put the reference at the end, a higher level of interest. Put the reference at the beginning, the highest level of interest. And just for fun, we spun the wheel one last time, and this is a description of a charitable remainder trust. The only difference is we start with no reference to a tax benefit, lowest level of making the gift. Then we bring that reference almost all the way to the front, higher level of interest in making the gift, and then we bring it all the way to the front, highest level of interest in making a gift. So we do see that these things matter. So we should talk about tax benefits. That's just for the benefit of any fundraisers in the audience, because you've probably gotten bad advice about that. My financial advisor folks know that's nonsense, and they start out with they certainly make those kinds of information known to the client. Now, since we're going to talk about tax benefits, how do we phrase that? How do we talk about those things? So here we asked people about what they wanted to read about on a charity's website, and different people had different options. This was the share that we're definitely interested in reading about this. And as you can see, there's not a huge difference in the different ways that you might describe the tax benefits, as long as you do describe them, right? Just saying you want to read about giving stocks, not so much. But if you want to read about avoiding taxes by giving stocks, people are much more interested in doing that. Notice also there is a slight difference where, and this is consistent throughout essentially all of our tests, the more simple words and simple language you can use to describe a benefit or a charitable gift or a transaction, the more people are interested in it. So you do notice, for example, that avoid taxes by giving stocks performs better than avoid capital gains taxes by giving stocks. One's a bit simpler, it's a bit shorter, people are more attracted to that. Do keep in mind that when we're talking about gifts of assets, those are actually much safer today for nonprofit organizations than they were before. Now, for those who are into the technicalities of it, we actually have new legal instruments that we didn't have 10 years ago, such as a single asset LLC, where we can separate whatever liability comes from that asset from the rest of the organization. But for organizations that don't want to accept valuable but perhaps complicated assets, there is now, of course, an alternative, which is to use a donor-advised fund. So in other words, if you're representing a nonprofit organization or a client, you've got a client who wants to give something valuable to a nonprofit organization, but the nonprofit organization has got a grumpy CFO, says, I don't want to deal with that, real estate or whatever kind of weird object it is. The answer isn't no. The answer now is simply not a problem. We can take that gift. We just need to run it through a donor-advised fund. There are donor-advised funds that exist today that will take any kind of valuable asset. I don't care whether it is a partial interest in a racehorse or unharvested crops, or in one example, an elephant ride business actually in India that had to be held for 3 years before it was sold. If it is a valuable asset, there are donor-advised funds that are happy to take those assets, and then ultimately, once they sell, it simply converts to cash that can then be distributed to the organization itself. So a lot more alternatives today than we had before. But notice I did say it's got to be a valuable asset. We're not looking for timeshares or other things that you don't actually want to end up owning. And you probably know this already, but there are no required minimum distributions for 2020. However, do keep in mind that even though there are no required minimum distributions, qualified charitable distributions can still be a very effective way to donate. Qualified charitable distributions actually are never limited by required minimum distributions. The limit for qualified charitable distributions has always been $100,000, and it still is this year. So it doesn't matter in any year whether that RMD is zero or if that RMD is $200,000 or $2 million or $2,000. The qualified charitable distribution is always limited to $100,000. Now, the reason we like these kinds of gifts is because it's better than the perfect deduction, right? It's better than the perfect deduction because we have money that we earn that we never paid income taxes on. And so we transfer this money that we earn that we never paid income taxes on to the charity, and we never have to declare that income. It never shows up. So it's like the perfect world deduction. Instead of getting income and a hopefully offsetting deduction, although fewer people are itemizing these days, we don't have to worry about any of that. We've got this perfect world scenario where in fact we're able to make a gift and that income never shows up. It never registers. So for nonprofit organizations and also for advisors, this is a good year to communicate to clients and donors that these two concepts are not linked. In other words, you can always make qualified charitable distributions up to $100,000. They are not limited by your required minimum distribution. So those are sort of two related concepts, but they're not limited. So you can still do QCDs this year. Do keep in mind QCDs have to go to regular functioning operating charities, no private foundations, no donor advised funds, no charitable gift annuities. And also a side note on there, if you have a donor who's making a QCD using a checkbook, an IRA checkbook, do get those in way ahead of time, because those actually, unlike regular checks, those actually don't count until the check clears. So it's got to clear before the end of the year. Whereas with normal checks, you don't worry about it. Once you stick it in the post office box, it is considered made. Okay, so let me get really obscure and wonky here, and that is something new that we can do with the Secure Act that feels a little bit like an above the line charitable deduction, but it's only for a special circumstance, which is this. And if you're interested in the full paper on this, just connect with me on LinkedIn. I'll send it to you, or send me an email. So the basic setup is this. If you have a donor couple who has earned income but doesn't want to add to their IRA balance, okay? If you have that situation, you can take advantage of it. And what that means is the idea is, look, if you just write a check to the charity, you get a deduction, but so many people can't use those deductions anymore today, right? So you can do this a different way. Instead of writing a check to the charity, you write a check to the IRA. If you've got a spouse that has earned income so that you can make this kind of an IRA gift, that transfer to the IRA is deductible. And then out of the other spouse's IRA, you make a QCD gift to the charity. So you have the same net effect. In other words, the combined IRA accounts don't change. Wife goes up, husband's IRA goes down, but the combined doesn't change. Charity gets a $7,000 gift, and the couple gets a $7,000 deduction. It's a deduction for contributing to an IRA. They didn't want to contribute to an IRA. They still like their balance. Not a problem. They contribute to the IRA, brings one up. But the QCD brings the other one down. So just a little trick, if you've got somebody who's got earned income but doesn't want to add to a combined IRA balance, you can do this. It can be done with any couple. They don't have to be married. It can be done with any couple. It's just that one person can't do it, because once you are doing that QCD out of an IRA, then that does not combine with making additional deductible contributions to the IRA, right? So it's got to be two people. Some kind of couple, doesn't have to be married, but some kind of couple that's jointly sharing financial resources. You can make this kind of a strategy. This is something that wasn't possible before, because before you had to have an age mismatch between the two couples. And now the change this year is that you can make these IRA deductible contributions at any age, right? So even if you're 100 years old, as long as you got earned income, you can still be making these deductible IRA contributions. So just one kind of wonky little strategy there that's available. Do keep in mind that retirement plan assets are the ideal asset for charitable giving. And that's not only during life, such as with the QCD, but it's also in estate planning. Retirement plan assets that are inherited by kids or any non-charitable beneficiaries, they get reduced by income taxes. So let me give you a quick example here. Let's suppose you got a client with $1 million IRA and $1 million house, and that's it. We say, oh, we don't need to worry about taxes because they're way under the estate tax exemption. Yeah, we do need to worry about taxes, not estate taxes. We need to worry about income taxes. Why? Because that $1 million IRA, if it's a traditional IRA, nobody's ever paid any taxes on that. So when it gets pulled out, they're going to have to pay taxes. So just a quick estate planning example. Does it matter which one goes where? And the answer is yes, it matters a lot. So let's suppose that we do it the wrong way. That's the left-hand side. The wrong way is we give the house to the $1 million house to the charity, and we give the $1 million IRA to the child. What's going to happen to that IRA? Well, when the child pulls it out, they're going to have to pay income taxes on it, right? These aren't estate taxes. These are income taxes. Child pulls that out, and let's suppose they're at top tax brackets, and even more unfortunate, let's suppose that they're at top tax brackets and they live in California. Well, what's going to happen? That $1 million, it's going to turn into less than $500,000. Those income taxes are going to wipe that out, and they can't deduct those California state income taxes anymore because they're capped out from the SALT limitations. So consequently, this is very painful. And oh, by the way, it got even more painful this year because now the child has to pull that money out even faster. They've got to pull everything out within 10 years, which we didn't have that requirement before. So consequently, very painful on the left-hand side. Let's go to the right-hand side. We switch that. Much easier. The $1 million IRA goes to the charity. What does the charity get? They get the full $1 million. We don't have to worry about income taxes because this is an exempt organization. Child gets $1 million house. What do they get? They get the full $1 million. $1 million house doesn't have this IRD or this income tax that hasn't been paid. So again, very simple concept, but very, very powerful if we do it the wrong way. If we want to leave a gift to charity, the very first asset, whether it's during life or at death, the very first asset we want to give to charity is that IRA or qualified plan money. So what are some good retirement plan charitable beneficiaries? You can make it a public charity, of course, a private family foundation, or a charitable remainder trust. Any of those work great. You cannot have it, for those that are familiar, you can't set it up with the charitable lead trust as the beneficiary. Those actually aren't tax exempt entities. And it's really tricky if you name the estate as the beneficiary and have the estate documents that are set up to then pay the charity. It's possible, but you got to have really intelligent counsel and careful drafting to make that work. By the way, sometimes you might hear that, oh, you don't want to do this because it causes problems. Look, the reality is these are problems that are so easy to avoid. They're not actually problems, right? These are traps that are so easy to walk around. They're not really traps. So in other words, we have this issue. Charities are not designated beneficiaries. This could accelerate RMDs for other beneficiaries. Look, simple way to solve that. If the charity gets paid their share before September 30th of the year after the year of participant's death, this rule doesn't apply. I don't know of any charities who would say, oh, no, leave it in the IRA. We don't want the cash, right? So as long as you get the charities paid out within a year plus September 30th of the following year, then you're fine. I mean, if you don't want to do that, you could go ahead and separate the IRAs into different ones. You could do this before death. You could do this after death. But again, as long as you pay the charity out, you don't need to worry about this. So if you hear, oh, no, don't do that, ignore it. There's lots of ways around that problem. Let me mention another strategy. So a lot of nonprofits offer charitable gift annuities. And a charitable gift annuity, very straightforward, is a person makes a gift and they get back lifetime income. It's a fixed obligation of the charity regardless of market events. Now, just as a quick side note, these are the rates that are currently in place. Those rates are going to drop in a couple of days. They're going to drop on July 1st. So if you're representing a charity that offers these, you may want to use this as a motivation to get donors to act right now today. So who wants these? These are people who want income that won't change. Charitable remainder unit trust couldn't change if your investments go down or run out, such as a charitable remainder annuity trust, where if your investments don't go well, you can just completely run out. Now, I will say we did see after the last big market crash, we did see an increase in very large charitable gift annuities going to very large institutions. We just had people that finally said, you know what, I'm done with all this volatility nonsense. I just want the fixed payment to be, and it's backed by a very large, stable organization. How does the tax work on charitable gift annuities? Well, you get a charitable deduction when you make it, and then you get money back. But what that money looks like when it comes back kind of depends upon things like interest rates. Part of it's going to be ordinary income. Part of it's going to be tax-free return of investment. And we've got some other issues. So very straightforward. The charitable deduction is the value of what you give less the value of what you get back. So this is essentially how much you give less the value of the annuity. So the key issue here is that as interest rates fall, the value of the annuity goes up. Now, the deduction is falling as the annuity value increases. So there's a trade-off on this. There's a good and a bad. Now, the bad side is if you planned to use that deduction, in other words, if you're itemizing, those deductions are getting smaller. As the interest rates go down, those deductions are getting smaller. Now, if you do it before the end of the year, of course, you can go back a couple of months and use a slightly higher interest rate that we had a couple of months ago rather than the current rate, but you would have to close that transaction again before the end of this month, before the end of June. So on the deduction side, these low interest rates is actually bad because for the same charitable gift annuity, we get a lower deduction. So for example, just a quick comparison, if you have the same kind of gift annuity, the charitable deduction using the February rate would have been about $25,000. Using the April rate, it's going to be about $14,000. And again, as those rates go down, then that deduction goes down lower. Now, the good news is if you fund it with cash, you can actually use this deduction as part of that 100% of your income can be deducted with charitable deductions in 2020. If you purchase the charitable gift annuity with cash, this should qualify for the 100% deduction. Now, I've got a full paper on this. Let me know if you're interested in that. But just to kind of look at the code section, we need a qualified contribution. Qualified contribution, it's got to be paid in cash during calendar year 2020 to an organization described in 170B. That's a public charity. And so when we do a charitable gift annuity, that qualifies for all of that because it is a bargain sale. We make a cash contribution and we do get back something in return, but because it's a cash contribution to a public charity, we can use this. So don't want to get too wonky into the tax code for you there, but just a little bit as to how that works. Now, if the donor can't use the charitable tax deductions, then the situation reverses. The lower rates that we have right now, they're actually better. Why are they better? Because a larger share of the annual payments come back tax-free. The original investment amount is the amount paid for the gift annuity less the charitable deduction. As that deduction gets smaller, the original investment amount gets larger. That means that a larger share of the gift annuity payments coming back to the donor are tax-free. They're tax-free because they are return of investment. Part of each annuity check just gives you back some of the money that you paid. The rest is earnings and taxable, but there's no tax on getting back your own money. And so the way we calculate this means that as the interest rates go down, the amount of tax-free return of investment actually goes up. By the way, what kind of language do we use to describe these? Recently published a test on this for charitable gift annuity ads. You can apply this to any kind of complex giving instruments. The first thing we did is we wanted to test, should we talk about what you could do with the instrument, or should we talk about what someone else had done? So we tested identical language. You can see it here. One talks about you make a gift and receive a tax deduction. The other talks about Sarah made a gift and received a tax deduction. And which one worked best? Well, actually, it was better to talk about what Sarah had done than to talk about what you could do. So then we decided to show people a picture of Sarah using the same text, and our results got worse. So what's the problem here? Is it just this photo, the donor age? Is it photos in general, or what? So of course, being researchers, we decided to test a bunch more Sarahs. So again, identical text, we've got different Sarahs, and I'm putting a box around the best performing Sarah in terms of people's interest in making a charitable gift annuity based upon the age of the respondent. And as you see here, if you're able to age match the donor example with the person responding, you get people much more interested in that charitable transaction. How does this compare with text only or a non-donor photo? We use this one here of a campus shot. Well, similar age donor photos did better than text only or non-donor photos. Dissimilar age donor photos did worse. Why is this? It's actually not just about age. All of this relationship was statistically explained by the answer to one question. How much do you identify with Sarah? Either she's not at all like me or she's a lot like me. To the extent that people read that example and said, yes, this person's a lot like me, they were much more interested in the charitable planning instrument than if they looked at it and said, yeah, that person's not really like me. So it wasn't really about age. It was more about identification with the donor example. So really the message that you want to get across if you want to encourage a transaction is simply this: people like me do things like this. Okay, let's get a little bit more wonky now, and let's talk about the non-grantor charitable lead trust. What is this animal? Well, straightforward, it works like this. The donor gives money to a basket called a charitable lead trust, with the remaining amount going to family members. The charity receives payment for life, or typically for a period of years. Anything left over goes to the donor's heirs. Now, this is a tax planning strategy. We don't do this for any other reasons. We do this to cut gift and estate taxes. So we only care about this particular instrument if you've got a donor or a client in an estate tax situation. Why is this attractive? Well, it's attractive for this simple reason. You pay taxes on the projected amount that's going to go to the heirs. You don't pay taxes on the actual amount that winds up going to the heirs, okay? This is a big deal. So if the actual amount that ends up going to the heirs after you've paid the money to the charity over the years is higher than the projected amount, all of that goes to the heirs tax-free. So again, that projected remainder, what does it assume? It assumes that for the entire life of that charitable lead trust, 10 years, 20 years, whatever you want it to be, that those assets are going to grow at the initial 75-20 rate, okay? What does that mean today, right now? That means if you set one of these up this month or next month, it means that the assumption is those investments that you put into that charitable lead trust today are going to grow at 0.6% for the next 10, 20, 30 years, however long you want to set this up, right? Now, if you happen to be such an astute financial advisor that you can beat 0.6% over the next 10 or 20 years, well, all of that extra growth actually goes to the heirs completely, gift and estate tax-free. So using last month's rate, for example, let's suppose that you put $10 million into a charitable lead trust and you're paying out, say, $540,000 a year to charity. Now, what's the projected amount that's going to be left over at the end of 20 years? The answer is 0, right? If you're only returning 0.8% investment, then at the end of those 20 years, you're going to have nothing less. So what do you pay in gift taxes to set this up? Answer, same answer, $0, right? Because you're projected to leave $0 to the heirs. Now, what happens if the actual growth is not 0.8%, but it's 8%? Well, then you're going to leave $22 million to the heirs completely tax-free. You see why this becomes super attractive when your investment returns assumption for the entire life of the trust is based upon the initial Section 75-20 interest rate. That interest rate is 0.6%. And so we get to take all of the growth above 0.6%, we get to take that tax-free. If you've got a donor who's already charitable, who's already planning to make either current gifts or in an estate context an estate gift, then if you set one of these up and you set it up so that the projected amount left over at the end is $0, well, this is like, I mean, it's like a free chance at tax-free transfers to family. There's no downside to this when you set up what's called a zeroed out CLAT. Much more powerful now with those low interest rates. So how does this work during the life of the charitable lead trust? Well, the trust itself is not an exempt entity, so it pays income taxes. But here's the good news: that trust can deduct those charitable distributions, usually completely without income limitations. So let's say you've got a donor who they're making charitable gifts, but let's say they're capped out. They can't use those deductions because they've made too many charitable gifts. This happens a lot with high wealth donors because they've made donations out of their wealth, which is very large, but those donations are much larger than their income. And so because of that, they can't use any more charitable tax deductions because they're already capped out. In other words, those deductions are already larger than, depending upon the type of the gift, than the 20%, 30%, 50%, or even 60% of their total income that can be deducted. So they can't use those. Well, if you shift those deductions over into the charitable lead trust, those deductions you can count up to 100%. They offset that income. So that income is coming into the charitable lead trust, but those deductions can wipe out, in fact, they can wipe out all of that income. So you've protected all of that income in the meantime. So you're starting to see how these complex techniques really start to stack the benefits. We're making this transfer. All of that extra growth goes to the heirs tax-free, and I mean estate and gift tax-free, but in the meantime, we've been able to protect all of that income that's been earned because we get to directly deduct those transfers to the charity. So a complex technique, it's only for people who are in that estate giving kind of scenario, but it is a technique that can be really powerful if you've got clients in that setup. So also, by the way, there is a version of this that works for people who don't care about estate taxes. So you can use this to impact income taxes, but that's a different kind of an animal. Unfortunately, it's also called the charitable lead trust. It's called a grantor charitable lead trust. The way it works is that you make a transfer into the trust, same as before, that trust makes payments to a charity. The difference is whatever's left over at the end comes back to the donor. Since whatever's left over at the end comes back to the donor, we don't worry about estate and gift taxes because it doesn't leave the estate, but the donor can actually right now today, this instant, deduct all of all of the charitable payments that are going to be made over the entire life of that charitable lead trust. Now, that deduction, of course, depends upon the interest rates when it is set up. And so that deduction is much higher today because the interest rates are so low. So just a quick example, let's suppose somebody was going to make $10,000 a year in donations to a charity or charities, can be multiple charities, and they wanted to take the deduction right now today for the next 20 years worth of donations. They can do that through a charitable lead annuity trust grantor clat, and the deduction for doing that is very close to that full $200,000 today because we have such low interest rates. By the way, these instruments are really cheap to set up. You can go to iclat.net. They do a high volume of these for very cheap, so it can be done readily for clients. Now, you know, one person asked me a question about this and said, well, why don't you just use a donor advised fund? Because, you know, then you get the full amount of whatever you transfer. Well, here's the big difference. You don't get the asset back with the donor advised fund, right? With the charitable lead trust, whatever you put in there at the end of the 20 years, you get it back. So, you know, you put in an asset and say, well, hey, at the end of the 20 years, I want this thing back. You can get it back. You just make those charitable payments off of that asset in the meantime, perhaps off of the income or whatever. So that's what makes it dramatically different than a donor advised fund, because you actually get the asset back when you're done making those charitable payments. But you can take the full deduction right now this year. This is a big deal if you've got a donor that has a big spike in income. Let's say they're doing a Roth conversion, for example, massive spike in income. We can use this to create a massive offsetting tax deduction. Charitable remainder trusts, these are also quite powerful. We make that transfer to the charity and we get income back from that donation during life, payments during life. Whatever's left over goes to the charity. We do this for two reasons. One, we get an immediate tax deduction for what's going to go to the charity after death, but also we can sell that asset with no capital gains taxes and we can get payments off of the full, payments off of the full amount that was transferred to the trust. Now, does this kind of a transfer qualify for that 100% income limitation? I'm going to say no. There are others who make an argument that it might, but I'm going to say that you're transferring it to an organization that is not a Section 170B organization. So I'm going to argue no. It's not a settled question, and it never will be, because this is only a one-year rule that we have for the 100% income limitation. So again, the benefits of a charitable remainder trust: you get income with no upfront capital gains tax. That means you get to earn money on the entire amount, unreduced by capital gains taxes. You get a tax deduction right now. By the way, for charitable remainder unit trust, this tax deduction, unlike a charitable gift annuity, this hasn't gone down with the interest rate. So charitable remainder unit trust, the deduction is the same. With the CRAT, the deduction is smaller, but we've actually got this special rule that we're now allowed with CRATs since 2016 that says we don't have to worry about the CRATs exhausting as long as we draft into that once that CRAT hits 10%, an amount equal to 10% of the present value, it then distributes out to the charity. We can draft around this issue, so not a problem. Just a quick example here. On the left-hand side, donor has $1 million asset, zero basis. They sell it. They pay capital gains tax. They've only got $762,000 left over, so they've got less that they can earn money with. That means they have less income, and also it could be taxable in estate tax. The heirs receive less, whereas on the flip side, if we actually transfer that to a charitable remainder unit trust, we can sell that $1 million asset, pay no upfront capital gains tax. We can earn money off of the full $1 million, and we get an immediate tax deduction. We can take part of that higher income, part of the value of that tax deduction, buy life insurance with it so that the kids still get an inheritance. If we run it through an ILIT, then they get an estate tax-free inheritance. So it's kind of a cool way where you generate much more income and you also generate a tax deduction. So the charity can end up with $1 million gift without affecting the client's ability to have income to use during life or the heir's ability to receive net of taxes and a gift, an estate gift. So for financial advisors, use of charitable remainder trust increases assets under management for a number of reasons. Number one, you can sell an asset with no upfront capital gains tax at the sale, so you're managing more. Also, you have tax deferred growth. Only the distributions are taxed. It works kind of like an IRA. Anything that stays inside the charitable remainder trust, it grows in a tax-free environment. Plus, you get an immediate tax deduction. That gives you more income. Plus, if you then transfer it to a donor advised fund or private foundation, you can often continue to manage those funds for multiple generations. Okay, one wonky little thing I want to end on, and that is retained life estates and remainder interest in homes and farms. A remainder interest gives you the right to own a property after a set time, or typically after the death of a person. However, unlike a will, a remainder interest is not revocable. So once you decide to do it, you can't change your mind, and you have to do it through a deed. You can't do it through a trust or some other instrument. It's actually a super simple instrument. It's just one line on a deed that transfer life estate comes to me, remainder interest to the charity. That's all there is to it. Now, why do we care about these things? Because the deduction we get depends upon the interest rate, okay? So you can take a deduction right now today for donating the inheritance rights to any kind of farmland. You can also do it with the personal residence. So any kind of a farmland or personal residence, you can get an immediate income tax deduction right now this year for donating just the inheritance rights. The reason you get that deduction is that it's irrevocable. But notice the difference in the size of the deduction. Let's say you've got somebody that gives the inheritance rights to $1 million of farmland. Okay, if they did that in 1989, they would have gotten a deduction of $122,000. If they do that this month or next month, they get a deduction of about $860,000. Okay, massive, massive difference. And in fact, if you're worried about, oh, well, you know, the kids who don't want to farm anyway, they're not going to get this inheritance, well, just take part of the value of that tax deduction and buy life insurance with it, right? And so everybody's happy at the end. Look, these low interest rates are giving us crazy, crazy results. I want you to wrap your mind around what this is saying. The tax deduction difference between donating the inheritance rights to farmland for a 55-year-old donor, okay, not that old, right? The difference between in the tax deduction for donating the inheritance rights to the farmland or actually donating the farmland itself, you only get like a 14% reduction of that tax deduction you would get if you actually gave up the farmland itself than if you just donate the inheritance rights, right? Crazy, crazy world that we're in right now. Okay, so do keep in mind, these things are irrevocable. Once you do it, you can't change your mind, but it does immediately increase assets under management because massive, massive tax deduction. You're not going to have to write a check for that tax to the IRS. You're going to have more money to manage because, look, as a financial advisor, you weren't managing that farmland asset, right? You're not getting fees off of that. But if you get this massive tax deduction, that's going to increase your assets under management. Gifts of remainder interest with retained life estate. You can do those in personal residences as well. Calculation is a bit more complicated, but those are available. And you can do this with any personal residence. This can be a second home, vacation homes, even a boat with bathroom, cooking, and sleeping facilities if it is used by the donor as a residence. A few other quick notes to end on here. Cash giving, we do have up to 100% deduction. And for some people, the 2018 tax laws bumped up the benefit of giving. We don't have any PEAS limitations anymore. There are higher state tax benefits for giving because of the SALT cap limitations, and we've got higher income limits for gifts of cash. Also, one quick note, the new 20% deduction for business income phases out at higher taxable income. Very weird provision. We've never had this in the tax law before, but what it means is that charitable deductions, they actually reduce that taxable income. So if you've got somebody whose taxable income is so high that they can't use that deduction for business income, they can actually donate in such a way that brings their taxable income back down so they can use that benefit, that deduction. Well, that's a little bit about some special financial planning opportunities right now in June 2020 with a focus on charitable planning. I've reached the end of my time, so we get the opportunity to open it up for questions. So I'll go ahead and stop sharing the slide there and move it back to the video and open it up for any questions, comments, thoughts that people might have. All right, so I do see one question that's here. I don't know if anybody else wants to read these off or if you'd like for me to.
Well, first, this is Liana, and thank you so very much for that presentation and all that wonderful information about all the opportunities that we can use either as professional advisors and or as development people. There are a couple of questions, more than a couple. One is, are there any special marketing tips for donor advised fund sponsors at this specific time? And I'll also add, while you're answering that, in your research, you talked about people identifying with the photos and increasing that response. And how would you, as marketing donor advised funds, would you market to a diverse audience if you have limited opportunity?
Right, certainly. So the concept that we want to get across is people like me do things like this. Now, there's a lot of different ways that we can share similarities with other people. Now, for example, the experiment we used looked just at age, okay? But as you're sharing other examples, there are lots of ways that you can point out ways in which this person is like the person you're communicating with. So for example, let's say you're communicating with a 20-something audience and your example is of an 85-year-old donor. Don't mention that it's an 85-year-old donor, right? Just mention it's someone like you who supports this cause or this organization or, graduated from this institution or, whatever it is. So there's lots of different ways of connecting with similarity. We don't need to say, for example, the result of that doesn't mean, oh, you always have to age match. No, it doesn't mean that. It means you have to connect with the identity. And so if there's an age mismatch, then don't focus on the age as a factor. If there's a mismatch on some other factor, don't focus on that factor. Focus on the ways in which the example that you're giving is similar. And so in some cases that means, for example, it's better not to show a picture. It's better not to show a picture than to show a picture that people are going to say, oh, that's not like me, and for different people, there are different characteristics that cause them to say, oh, those are other people. Those people aren't like me, right? Different people respond to that differently depending upon which demographic characteristic you're looking at. But, if they're going to respond with that, oh, that's a mismatch, then do a different kind of picture. We don't have to point out those differences. As one example, I was working with fundraiser, and they were having a challenge because they had one of their donors who agreed to be profiled in a donor magazine about a gift annuity they had made. And so that was great. You have a donor story, want to take their picture, but they were fairly wealthy and they really wanted to have their picture taken in front of their yacht, right? And so the fundraiser kind of had explained to them, well, that actually isn't helpful if you're standing in front of your yacht. Why is that? Because it doesn't send a message that people like me do things like this. So again, we always want to find those sources of connection, and we can do that regardless of what the difference is between our person and our audience. We can find those sources of connection. In conversation, it could be something as simple as, and this is actually very powerful, something as simple as saying, you know, you remind me of another donor I was working with who blah, 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 right? We're starting out with people like me do things like this. So that can be very powerful. When it comes to donor advised funds, you know, this is for fundraisers. This is certainly a time to encourage those who have donor advised funds to make those gifts. That, you know, this is a crazy time. This is what you've been saving up for, you know, for all of these things that are going on. And we're seeing some of the power of that. We actually saw this during the last downturn. We saw this with private foundations. Private foundations actually temporarily turned up their giving when we had a market crash several years ago. And now we're starting to see some early data that shows that individuals are doing the same thing with the donor advised funds, that they're starting to crank up the giving in response to the market conditions, which is actually really great because just people writing checks tends not to respond well to market crashes. But since they've already set the money aside, then they're much more comfortable in saying, well, let's go ahead and put it to use now. So we saw it before with data from private foundations. Early data now is showing that we're seeing this with donor advised funds as well.
Thank you. Another question is, can you discuss QCD limitations if the donor is still working and contributing to the IRA?
Ooh, good point. Thanks for that. And I should have pointed that out because we do have new rules now where the same person can't combine both of those things. In other words, once you, when you are doing, once you're old enough to do the QCDs, if you are still making those deductible contributions after that age, I believe it's age 72, if you're still making those deductible contributions to your IRA, well, you've actually got to burn all of those off before your QCDs work like QCDs. Before that point, they just work like you declare the income, then use the deduction if you can. So it's one of these challenges that, you know, the good news was, hey, now any age can deduct the contributions to an IRA if you've got earned income. The downside is that you can't also do the QCD without burning off all of those 72 and older contributions, which is why in my example, I tried to separate those two. You know, if we've got a couple and we say, okay, this is the QCD person and this is the earned income IRA contribution person, because we can't stick those together to be the same person at the same time. Or if that person has earned income and a deduction at age 72 or older. But do keep in mind that QCDs are still available at 70 and a half or older. That didn't change, even though the RMDs changed to age 72.
Thank you. Do you have a recommended minimum amount to establish a charitable lead trust for maximum results?
So it depends on which kind you're talking about. If you're talking about the income tax kind, those are actually super cheap with that iClat.net company that's doing that. And so, you know, you can take a look at how much it costs to set one of those up and, you know, kind of do, okay, my deduction is going to be this much. And, you know, so that's pretty straightforward. The estate planning charitable lead annuity trust, those are all handcrafted, individually designed by an attorney. And also this is an estate tax planning situation. So you got to have a pretty big transfer. I mean, you know, if you're not, you know, don't have this conversation for less than $1 million. I mean, you know, this is going to be a major transfer. And that's what we see in the national data. Charitable remainder trust, a lot more of them, but they're smaller. Charitable lead trust, they're a rare animal, the estate tax planning version, but they're a massive animal. They tend to be 20 million plus when we're looking at those estate tax planning charitable lead trusts.
and then I'm going to try and squeeze in one more.
Sure.
Can non-cash assets be used to fund CLTs or CRTs? And is there a difference in the tax treatment?
Yes and yes. So you can, you certainly, in fact, we want to generally use non-cash assets. For example, with the charitable remainder trust, we want to use non-cash assets because we can sell it with no capital gains tax. If we do that outside the charitable remainder trust, you know, we get hit with that tax right up front. If we do it inside the charitable remainder trust, no upfront taxation on that. We can continue to grow and get income off of the full amount. The deduction is different because you are not contributing cash, you are contributing property, and the income limitations on how much of your income you can wipe out with those deductions are different for contributing property as compared to contributing cash. Charitable lead trust, it's not a tax exempt entity, so we don't get that same benefit from capital gains tax. And we also, if it's an estate tax planning one, then we're not worried about it. We're not worried about it. It doesn't create a deduction that we're going to be able to use individually. It creates a deduction that the charitable lead trust itself uses, and that actually doesn't matter. It can deduct up to 100% of whatever it's transferring at that point, because it's got to convert it to cash before it gives before it donates it anyway. So again, it's unfortunately confusing that we have the same term for two very different instruments that are both called charitable lead trusts. But answer is yes, you can do that. It's a great strategy. It does change the amount of your income that you can wipe out with those income tax deductions.
Thank you. And I just want to read one comment from one of our attendees. She said she just wanted to say, wow, and thank you.
All right. Thanks so much. Very nice.
I also want to remind everyone that there will be an evaluation at the end of the presentation, and that you will be able to receive the PowerPoint presentation as well. And now I will introduce Lisa Stenger from the Jewish Community Foundation and Sharon Closius from the Valley Community Foundation, both to say a few words.
Thank you, Mr. James. That was amazing. And thank you, Community Foundation and Valley Community Foundation for working with the Jewish Foundation on this. I know everyone, we learned a lot and people want to get back to work. So I'm not going to say anything else other than thank you for participating. And I will turn it over to Sharon.
Yep, and I will actually echo exactly what Lisa just said, and Liana and Dr. James. It was wonderful to hear you. It's always fantastic to have a professional advisor be able to communicate this in such an enthusiastic way. So, and in a very simple way, but a lot of information. And I look forward to getting those PowerPoints. So thank you for being with us today.
Yes.
Happy to be here. Thank you.
For coming to us from Texas. We greatly appreciate it. And I will say good afternoon to everyone at this point. Thank you.
Thank you.